Take a closer look at the economy with John Herrmann of State Street Global Markets. John, by the way, is one of the most accurate forecasters of the economy. We call him a Bloomberg Best and a friend to Street Smart. John, put it into perspective. I mean, I think Mike brought up a good point. I think Alan Blinder brought up a good point. Why should any of us have been surprised by the Fed's assessment of the economy yesterday?
Well, I think it's a little bit more profound than what Professor Blinder is suggesting, and here's why. The Fed for the last 7 or 8 months has been saying there's just temporary factors that have been the headwinds in the economy, and now the Fed is really coming forward and being, more fairly disclosing in that there's really structural, persistent, long-term structural problems with the U.S. economy, and that's what's really slowing us down. And the policy solutions aren't quite there to really change that situation. So I think the Fed was far more disclosing this time and in much fairer disclosure.
John, what if the policy moves were there to address it? And I bring that up because earlier our Tom Keene spoke to Christine Lagarde, the managing director over at the IMF. She spoke about whether or not she thinks there is a path of recovery. Listen up, everyone.
Although the situation is difficult, the growth has slowed. The downside risks are high. I think that there is a path for recovery if there is a collective drive and a determination to actually address it.
So if there is a drive, a collective drive and a determination to actually address it, John, I mean, all signals say probably not.
It's asking for a lot.
It is asking for a lot.
I mean, it's asking for a tremendous amount, not just in the Eurozone, but also here at home. And then it's asking, for a lot of coordination of policies, back and forth between Europe and the United States. And I think that's really asking a lot, especially when at home, Congress really isn't even on the same page. So I think, the other things to keep in mind is, when we just look ahead near term, we're looking for payroll gain, a small payroll gain in a couple of weeks, but that number, we're actually looking negative. If we take out the striking Verizon workers, we think payroll is going to be negative on October 2nd. Inventory stocking in the U.S. very, very cautious. We're looking for ISM to pull back further, below 50. We just have a host of risks. The income, here's a key measure, real income has decelerated to just 1.25% growth in the third quarter, and I have it going flat in the fourth quarter. It's very difficult to even grow GDP when there's flat income growth. So I think, the situation is coiling for a recession. Shock in Europe would definitely exacerbate it. The Eurozone growing so slowly, 25% of U.S. exports go to Europe. 25%.
John, let me ask, the Secretary of the Treasury today made a comment that I had to read like 4 times before I really believed that he said it, and I'm not still sure. I want to play the clip. Listen to what he says and tell me if you think it's going too far. Here's Tim Geithner.
Great Depression. It caused enormous damage to the basic fabric of commerce people have in their economic security. We're still living with that. It's still scarring damage. And we have a political system that looks manifestly broken, and it makes people nervous about the future. That is within our capacity to fix, as it is to heal the damage caused by the crisis. We just got to keep at it, make sure we're doing things that are good for growth.
All right, so I'm still not sure if he said we're sitting at the edge of a second Great Depression. Would that be too far? And can you believe that the Secretary of the Treasury would say something like that?
It sounds a little bit extreme, but the thing is, when you look at household balance sheets, there's been very little in terms of improvement and deleveraging over the last 3 years. We've been talking about deleveraging for 3.5 years, and on the margin, when you take out the defaults and foreclosures and delinquencies, there's very little improvement there. So, households still have a long way to go here, and this is an issue. And then, really, I think the key thing that the debt ceiling debate revealed was just how far apart leading congressional officials are on what the solution is and what path we're going to go down. So it just seems that the American people in a year from now are going to have to vote on where we're going.
All right, John, you know what? We just crossed over a loss of more than 500 points now on the Dow Jones Industrial Average, so you can definitely see it playing out in the markets.
So wait,
I feel like Carol's trying to jump in here.
I want to make sure I didn't miss something. So, John, I don't know. If we talk again in a month or in 2 months, will we be in recession? Will we all be saying, well, we saw it coming, here it is?
Yeah, it's going to take a couple of months to get the data, and you're right. And the job layoffs should pick up, so the jobless claims heading in towards the end of the year should be rising. So yeah, it's going to take a couple of months to accumulate the data. You know, we've been targeting the 10-year yield to 1.64. We think that's actually conservative. So we're thinking, you know, it's probably going to go, you know, towards 1.4% in 10-year yield.
Wow, that would be a real record low. A real record low.
Absolutely.
All right, hey, John Herrmann, thanks so much for joining us. John Herrmann there from State Street.
Thank you, Matt.